Missiles have fallen, oil fields are burning, and the Middle East is standing on the jagged edge of total war. In every textbook on finance, this is the moment gold and silver are supposed to moon. This is the safe haven play, right? But look at your screen. It's bleeding. Silver is down 3%. Gold is dropping by $100 an hour, and the panic is palpable. Why is the market behaving so irrationally? Is the world's most trusted store of value suddenly broken? Or is there a predator lurking in the shadows of the exchange, forced to dump their hoard while you're distracted by the headlines? Today we are going beyond the breaking news. We aren't just looking at the bombs, we're looking at the bank accounts. We're going to solve the mystery of why prices crash when they should be soaring. And I'm going to show you why this silver shock isn't a sign of weakness. It's a massive, violent transfer of wealth that most people are missing entirely. By the end of this video, you'll understand the secret mechanics of the margin call and why July 2026 has become the most dangerous and profitable date on the calendar. If you think the drop today is the end of the story, you're looking at the wrong map. Let's get into the data. Let's look at what the smart money is actually doing while everyone else is staring at the smoke. To understand why silver is crashing while the world is on fire, we don't look at the silver charts. Not yet. Instead, we have to look at what's happening deep inside the pockets of the big boys at Wall Street. In times of extreme geopolitical tension, like the strikes we're seeing on Dubai's oil infrastructure, the first reaction of the broad market isn't greed, it's fear, absolute paralyzing fear. This fear triggers a massive sell-off in the S&P 500, the Nasdaq, and banking stocks. When these trillion-dollar equity markets start to tank, the most dangerous phrase in finance starts echoing through the halls of investment banks: the margin call. Think of it this way. Imagine a massive hedge fund. They're heavily leveraged, meaning they've borrowed billions to bet on tech stocks or high-growth sectors. Suddenly, war breaks out. Those tech stocks plummet 5 or 10% in a single morning. The brokers then call the fund manager and say, "Your collateral is no longer enough. You have two choices. Give us more cash now, or we start liquidating your assets." But here's the problem. In a panic, you can't sell what you want to sell. You sell what you can sell. You can't offload millions of shares of a crashing stock without taking a massive haircut. So what do these funds do? They turn to their winners. They turn to the assets that have high liquidity and haven't crashed yet. They turn to silver. They turn to gold. They dump their silver positions, not because they've lost faith in silver, but because they need the cash to keep their entire firm from collapsing. In the eyes of a distressed fund manager, silver isn't a safe haven today. It's an ATM. It's a source of emergency liquidity. This is why you see that massive red candle on the chart right as the news of the Iranian drones hits the wires. It's not a rejection of silver's value. It's a mechanical liquidation. History proves this. Look back at the 2008 financial crisis. Look at the COVID crash of March 2020. What happened to silver and gold in the first few weeks? They plummeted. Why? Because the entire financial system was gasping for air, and it used precious metals as an oxygen tank. But here is the logic you must grasp. This selling is temporary. It is forced. It has nothing to do with the fundamentals of silver, and everything to do with the fragility of the paper stock market. When the smart money sees these margin calls, they don't panic. They wait. They know that once the hedge funds are done liquidating their ATM, the physical reality of the silver market remains unchanged, or better yet, it's actually stronger because of the war. So while the headlines are screaming, "Silver is dead," the professionals are whispering something else. They are watching the liquidity dry up, knowing that this is a shakeout. They're watching the weak hands, those forced to sell, hand over their silver to the strong hands at a 3 or 4% discount. But this is just the first layer of the trap, because while Wall Street is busy selling paper silver to cover their stock losses, something much more sinister is happening in the physical vaults. And if you think a margin call is scary, wait until you see what happens when the paper shorts realize there's actually no silver left to buy back. That leads us to the real market trap, the gap between what you see on a screen and what actually exists in a vault. Let's move into part 2, the liquidity paradox. Now, keep your eyes on the ball, because this is where the plot thickens. We just talked about the margin call, the mechanical selling that creates that scary red candle on your screen. But what if I told you that red candle is exactly what the smart money has been waiting for? Welcome to the liquidity paradox. On the surface, it looks like silver is losing value. But beneath the surface, there is a massive, silent divergence. While the paper silver market, the world of digital contracts and IOUs, is getting slammed, the physical silver market is screaming. Let's look at the COMEX. The silver inventory there just hit its lowest level since December 2024. All that buildup we saw throughout 2025, it's gone. Vanished. It's being eaten up by industry, solar panels, EVs, AI infrastructure, and by smart stackers who know that you can't build a green future with a digital contract. So why does the price keep falling? Because you are watching a market trap. This is the shakeout. The big institutional shorts, the people who have sold billions of ounces of silver they don't actually own, need you to panic. They need you to see the war news, see the price drop, and say, "I'm out, silver is a scam." Why? Because your panic provides the liquidity they need to buy back their short positions at a cheaper price. It's a classic bait and switch. They use the cover of a geopolitical crisis to trigger technical sell orders. If they can push the price below key support levels, it triggers a stop-loss cascade. More selling leads to more selling, and while the average retail investor is staring at their phone in horror, the vaults in London and New York are quietly being emptied. Think about this. Silver trade data shows that 96.7% of the global silver inventory is concentrated in Western vaults, but that supply is being drained at an unsustainable rate. Some analysts are now whispering about a force majeure event. For those who don't speak legalese, force majeure is the get-out-of-jail-free card for the exchanges. It happens when the exchange admits they have run out of the physical metal to deliver to the buyers. If that happens, they don't give you silver. They just hand you a check for the cash value and tell you to go away. But here's the kicker. If you get cashed out during a force majeure event, you've lost. You missed the moonshot because you no longer hold the asset that is skyrocketing. This is why holding the physical metal or having a position that isn't tied to paper leverage is so critical right now. We're witnessing a violent transfer of wealth. Wealth is moving from the paper hands, the people who trade based on 5-minute charts and fear, to the strong hands, the people who understand that a missile strike in Dubai doesn't change the fact that the world is running out of silver. Peter Schiff recently pointed this out. Traders don't realize how bullish these war events actually are. They see red and they run. But the smart money sees red and they see a discount. They are taking advantage of your ignorance. But you aren't ignorant. Not anymore. You now understand that this price drop is a mechanical glitch caused by a broken financial system, not a reflection of silver's true worth. However, understanding the trap is only half the battle. You need a way to navigate this volatility without getting wiped out before the July 2026 deadline. How do you tell the difference between a real market crash and a temporary liquidity flush? And more importantly, how do you position yourself so you're the one buying the dip, not the one being dipped? That brings us to the most important part of this analysis, the read-on strategy. Let's move to part 3, where we look at the specific indicators you need to watch to see through the smoke of the silver shock. So the screen is red, the news is terrifying, and your gut is telling you to run. How do you stop being the prey and start being the predator? You need to learn how to read the chaos. You need a filter to distinguish between a dying trend and a temporary liquidity flush. Here is your tactical playbook for the first 48 hours of any geopolitical shock. The first thing you must check is not the silver price, it's the USD index, the DXY. Currently, we see the dollar soaring. Why? Because when war breaks out, the world flees to the dollar as the cleanest shirt in the dirty laundry pile. Other currencies are inflating even faster than the dollar, pushing the DXY up and weighing heavily on precious metals. This is a technical pressure, not a fundamental one. If silver is down but the DXY is hitting vertical highs, you aren't seeing a silver collapse, you're seeing a dollar spike. This is your first clue that the move is driven by currency flows, not a loss of value in the metal itself. The second indicator, the US national debt versus GDP. We just crossed the 100% threshold. Historically, once a superpower hits this level, there is no turning back. The interest payments alone become a black hole. When you see silver dropping despite this massive debt load, ask yourself, has the debt disappeared because of a drone strike in Dubai? Of course not. In fact, war usually means more debt and more money printing. The smart money looks at that scary debt chart and realizes that the response to this crisis will be the same as every other crisis. The government will light up the printing presses. Inflation isn't going away, it's being fueled. This means the current drop in silver is a massive mispricing. The market is offering you a discount on the very asset that protects you from the printing press, just as the printing press is about to go into overdrive. Now, let's talk about the July 2026 finish line. Why is this date the kill zone for the shorts? Remember the government proclamation we discussed earlier? The 180-day window for the Secretary of Trade to establish price floors for critical minerals ends on July 13, 2026. We are currently in the eye of the storm. The liquidity crash we're seeing today is the final shakeout before the legal and physical reality of the silver floor kicks in. Think of it like a spring being compressed. The margin calls and the paper selling are pushing that spring down tighter and tighter. But the physical demand from the green energy sector and the 100% debt to GDP reality are the floor beneath that spring. When that spring is released, likely around July as the government mandates take effect, the move will be violent. We've seen silver gain 170% in just 3 months before. A 200% rally from these levels isn't just a fantasy, it's a mathematical possibility once the paper shorts are forced to cover in a market with no physical metal left. Your strategy right now? Stop looking at the 5-minute candles. Start looking at the macro timeline. If you are buying when it's red, you are doing what 99% of people are too afraid to do. You are accumulating strategic resource units while the rest of the world is trading panic tickets. But let's be real. Holding through this kind of volatility isn't easy. It requires a specific mindset and a clear understanding of the end game. It requires knowing exactly when to stop listening to the noise and start listening to the data. As we wrap this up, I want to leave you with one final thought on the difference between being a trader and being a stacker in the age of the silver shock. Let's head into the conclusion to bring this all home. So, we've connected the dots, from the chaotic missile strikes in Dubai to the silent margin calls on Wall Street, and finally to the looming deadline of July 2026. The paradox of falling prices in a time of war isn't a signal to run. It is a loud, clear invitation to look closer. While the headlines want you focused on the smoke and the fire, the data tells a different story. A story of massive debt, industrial scarcity, and a broken paper market that is running out of time. Remember, war is a temporary catalyst for panic, but debt and physics are the permanent drivers of value. The national debt exceeding 100% of GDP is a bell that cannot be unrung. The depletion of physical silver from Western vaults is a reality that no amount of paper manipulation can fix forever. The silver shock is coming, and in the world of high-stakes finance, you are either the one providing the liquidity or the one taking advantage of it. If you are holding physical silver or gold today, you are holding something real in a world drowning in digital promises. So I have to ask you, after seeing the mechanics behind this drop, are you choosing to follow the crowd in a panic sell, or are you seeing this mispricing as the ultimate opportunity to grow your stack? What is your move before the July 13th deadline? Share your strategy or your thoughts on these market traps in the comments below. I'll be jumping in to discuss the data and the macro outlook with you all. Thank you so much for watching. Stay calm, stay informed, and I'll see you in the next one.